In other business news, the first quarter Altron FinTech Household Resilience Index has flagged an 8.7% drop in the ratio of income to debt cost as the most concerning in the current economic climate. The index has pointed out that households are sacrificing 6.7% of their disposable income to pay debt. It's also noted that this reading confirms the ongoing financial strain on South Africans, which is mainly due to the elevated interest rate level. Economist Dr Roelof Botha speaks to us now. Thank you so much for your time, Dr. Botha. It's an interesting picture, especially because the situation seems to be worsening. So do paint a picture for us in terms of what this index is telling us compared to the previous figures that we received.
Yes, it's not a pretty picture. And I think I'm speaking on behalf of quite a large number of millions of South Africans that are battling to make ends meet because of this increase to a 15-year high in the ratio of debt service costs, which is essentially the interest that you pay on your mortgage, bond, credit card and overdraft, divided by your disposable income, 9.2%. I did a quick calculation. That is exactly how much the average household is spending every month on school education, medical services, medical products, clothing, fruit, plus vegetables, plus hot beverages, plus all household appliances, plus books. That's also, what I've just mentioned, is 9.2% of disposable income if you look at the consumer price index basket. This is not good news, and it's unnecessary because there is no demand inflation in this economy. There has not been any for the last 4 years.
And that's where I'd like us to pick up that particular discussion, solely because you've had quite strong views around the relationship that South Africa has with inflation as well as monetary policy. It is not going to be a picture that changes, especially with the meeting currently underway of the Monetary Policy Committee, that there would be a cut at this stage because inflation is still elevated at 5.2%. Your thoughts with regards to how this picture could be different?
Yes, I just must add here that a 5.2% inflation rate is, as far as I'm concerned, and many economists will agree with me, for a developing economy on the southern tip of this continent, which is so far removed from the major consumer markets and export markets, 5.2% is entirely acceptable. And by definition, it is acceptable because the Reserve Bank's target range is between 3 and 6%. My frustration is endless. I mean, I could kick a puff at her. I'm so mad at them because it's been in the target range, our inflation rate, for a year, for a full year. And I must tell the viewers that when Jill Marcus was president, the previous governor of the Reserve Bank, the average real prime rate, so you take the prime rate, today it's 11.75%, I think we all know that, minus inflation, which is 5.2 today, it's 6.5 today. On average, when Jill Marcus was governor, it was 3.1%. This is a 110% increase in the cost of capital and of credit. It does not make any sense at all.
So, to use your argument, if at this level the South African Reserve Bank's Monetary Policy Committee meeting has room to at least cut, and they may do so maybe moderately, but at least some easing on the side of the consumer, how much of relief would that be?
Well, unfortunately, they apparently like the term hawks. And for some reason, they think that we are in America because they just copycat the Federal Reserve. But they must just have a look at the differences between South Africa and America. America has virtually full employment. If you factor in voluntary unemployment, which is running at about 4 to 5% of the workforce, America has full employment. We do not have full employment. We need jobs at pace. And I can tell the viewers that the bond yield, the South African 10-year bond yield, has dropped in the last 2 months by 144 basis points. This means that the Reserve Bank is so in deficit, so far back. They should lower interest rates as quickly as possible to where it was before COVID. And even then it was too high. It was 10% before COVID. It's 11.75% now. It is damaging this economy's propensity to create jobs and to generate growth.
Lastly, Dr. Botha, would an ease in interest rates solve the problems that are indicated within the household index? Because it's a far wider issue for household budgets and spending.
Yes, households are just have to battle it out there. Johan Jellitley, the MD of Altron FinTech, is on record for saying that households in South Africa are quite resilient. It's really a pity that we have these unnaturally high interest rates. And as he's indicated, capital formation by new businesses is lagging behind. Because if your interest rate is too high, which it is in South Africa, it acts as a tax on venture capital. It's just too easy to put some spare money into the bank and get 10, 11%. That's what all of them are advertising. We need job creation in South Africa, quite frankly. So let's hope that on Thursday, they will come to their senses and start dropping interest rates. But they better hurry up.
We cross fingers. Thank you as always for your input, Dr. Roelof Botha there talking to us about the latest household index by Altron. Definitely not a pretty picture on the side of the consumer given the financial pressure that the country is under.